formal welcome now. We've got David Rolfe, who's partner at NVM Private Equity out in the Thames Valley, is where I predominantly know him from in Reading, but obviously NVM work across the country. David, I've known for quite a few years, very, very well respected in private equity circles, corporate finance, and what I call the transactional or deal making space. Nobody that I've met has said a bad word against him. Very, very well respected. And from myself, always a pleasure to work with and value his advice. And generally, he remembers whose round it is, which I always find quite liberating in those circles. So without much more ado, I'm going to pass over to David. He's got his topic that he's going to be speaking about today. Is making RUPE ready. And I can't think of anybody else more well suited to give advice on that. So hopefully you find it engaging. Over to you, David.
Yeah, thanks, Stuart. Well, nice to meet so many people. I know you're all on mute, but I think if you do have questions or anything, by all means, perhaps raise those at the end, because I'm happy to take those as well. I'll just do Stuart's given me a bit of an intro there. I'll do my own brief one. So I think I'm in good company. I'm a chartered accountant, so I was PwC for 15 years, and then I moved across to NVM 14 years ago to actually work on the investment side. So NVM is a mid-market PE house. We are regional, so we're across the country. We invest in all sectors as well. So hopefully this should be relevant to everybody. I think we do typically invest in businesses making between 2 and 5 million EBITDA. That's because we're investing levels between 5 and 20 million. And that's, I'd say, across all sectors. But even if that doesn't resonate with the business you're currently in, everything I say will be relevant, even if your size is larger, smaller, in terms of, the purpose of today is, are you PE ready? What do we look for in investments? How can CFOs and FDs help to prepare that and be ready at that point if and when that arises? And also, look, this is relevant for any exit. So whilst we take quite forensic looks at certain things, any buyer, whether it be trade or private equity, would probably be looking for very similar as well. So it's almost like a exit readiness with a PE slant to this. Just to put it in a bit of context, what we see annually, we would effectively receive probably 200 opportunities a year. So this would be what I would describe as an information memorandum, a booklet, a business plan from prospective companies. And of that 200, we might look seriously at 100. So we'll make a call very quickly as to whether it's something we think fits with our sort of parameters and our criteria. And that 100 we might look at in much greater depth and analyse. And we might meet 50 of those in the year. So broadly, just to put it in context, one a week maybe, and then you might make offers on 20 after you've met the team and moved it forward. And then you might actually go to a final offer on, say, another, of that 20, perhaps 10, and then you might, we'd aim to transact 2 or 3. So what you can see is there's a huge funnel that comes down to a very small number of deals being done. Now, clearly, we're not the only private equity house who would be looking at those, but I'm just trying to give a context of, to get from the 200 to the 100, there's certain things we look for, and that's what hopefully this will bring out as part of the discussion. So I think that, look, some of this will be quite, in some ways, basic, and you might think, yeah, well, we do that, and I know that, but I'll try and pull out the bits that we really focus on. So, and I'm conscious of the audience as well. So that the quality of earnings, firstly, the quality of earnings and the financial credibility is probably what I would call it. So when we are looking at a business and the numbers, clearly there is we want to see a clean, reconcilable number. We perfectly understand that the accounts that you've registered at company's house are not always the same as the management accounts, but what we will need is, a really sort of clear bridge between the two and a reconciliation, because actually, look, and not only just private equity, but buyers do lose confidence quite quickly if that reconciliation isn't there in a strong manner. And that's across all the numbers, whether it be revenue, earnings, gross profit, and everything. But usually the EBITDA is usually the one that has the biggest bridge, if you like. And that's a walk from, the sort of the adjusted EBITDA with all the add backs. And add backs are fine. We're used to seeing add backs just as long as they're credible. If it's one-off costs relating to something that is genuinely one-off, if it's shareholder costs that are not involved, they're, excess remuneration that you wouldn't expect to have in place going forward, that's quite normal. I think where we get frustrated is we see, some add backs will be like, the revenue we might have made had we employed 5 more people. I mean, it's great theory, but no investor is going to look at that and go, yeah, that's a credible add back. So I'd say that I think if you're breaking down the revenue, I would say the quality of the revenue or the quality of the earnings, but I always start with the revenue. So what I mean by that is show a split of recurring revenue versus one-off, or contracted versus pipeline, all pretty basic stuff, but actually having that detailed and seeing at what point of the year do you have 75% of your annual revenue contracted? When did you see it last year? Did you see it, by month 6, or was it month 8? And if you can track that progression, actually, it's really helpful for us to get confidence on exactly what the outturn could be, because the current year numbers will always be the most important when we're going through it. Because that's the one that when the time is coming to be critical, we just need to see that the business is performing. And I'll come on to a bit more about that in terms of forecasting in a moment. I think for us, margin analysis is always important. So if you can get that granular detail that says gross margin, whether it's by product or by service or by customer or by channel, that kind of, I mean, we quite often call it a data cube, but if you can get that data into a format that is just easily digestible, actually, that's the kind of information that, yes, we'll see a P&L, but we'll want to dive deeper into some of that detail. So that's more about sort of the financial credibility and the quality of earnings. I think supporting that is the second point, which is this robustness of the financial systems, controls and reporting. And this will be, I'm sure a majority of you should, I hope, be all over this. So this is all about, the timely closing of the management accounts and do they get produced within a sensible time frame, and have you got the most recent ones and delivering it to people as they're going through the process? Is there a reliable KPI framework within the business that you're tracking on a monthly basis? Whether that be, for a people business, just tracking utilization or something, whatever the key KPIs are that are being used within the business to drive it. I mean, we do expect to see, this isn't always the case, but, board meetings, some of the businesses we go into, we've got to be mindful of the fact these are quite small businesses. They may not have a particularly structured board sort of process and meeting. It might be quarterly. So we've looked at and invested in businesses that produce quarterly accounts as well. I mean, that makes it slightly more challenging. We'd much rather see the monthlies. But it does happen. That doesn't mean it can't. I just encourage anyone to sort of bring a tighter cadence to doing it monthly. I think cash is one that we're always very focused on. So whilst people might think it's revenue and profit, actually the cash is critical, because the way we will structure deals will have forms of debt attached to it. So having the ability to show the accurate, whether it's even a rolling 13-week cash flow, which is typically what we would like to see as we go through a deal, but just general for cash flow forecasting, and how easy is that to do? Also to see the working capital requirements going forward. So that's kind of much more about the sort of the infrastructure and the historic data that is being reported on. And I think then you've kind of got the next piece, which is the credible business plan. So when we look forward, obviously everything we see, and I talked about, we get 200 of these. So these are, this will be an information memorandum that is talking about everything in the business. So it's detailing, the investment highlights of it. It's detailing the management team. It's detailing the product or service. It's detailing the market. And then obviously there'll be a financial element within that. So when that, and typically, you would have an advisor that would assist you in pulling that information together, but just having the backbone of it all already there within, and it's usually the financial function that is responsible for, housing all that data and keeping it there. Having that ready at the right time is invaluable, especially as sometimes you can get an approach out of the blue from somebody who just wants to see that information immediately, and you haven't had the benefit of perhaps an advisor working alongside you for 4, 5, perhaps 6 months, which can be the case. So when we look for a credible, evidenced business plan, I would say it's building an equity story. So typically what we like to see is historic growth, because historic growth is a good proxy for what we're going to see going forward. That's not always the case, but if you have got a flat or even declining profile in the historical trends, and this I'm talking sort of revenue and earnings, then it does make the story needs to be far more robust as to what is changing to make that. Because look, no surprise, we do see an awful lot of hockey sticks in business plans, which in most cases you can buy into if you've seen there's reasons why, whether it's been a change of management, a change of strategy, or whatever. It's got to be compelling and consistent with the numbers. So, and be able to articulate. So if it's around new markets, if it's around new products, if it's a pricing difference, or actually if it's M&A could be a key point. I think if you're ever going to put M&A into a business plan, I think it needs to be well thought through. So we've seen, both types. We've seen yes, we're going to acquire a business here that's going to add this and add that. The first question we've got is, well, how far, what is that business? How far are you with the discussions of that business, and how, if you even commenced conversations? That's when they tend to fall down. The good ones are where you've got, there's a pipeline of perhaps 5, 6, maybe half a dozen up to 10 businesses that the company is aware of, has made tentative inquiries, understands enough about them, thinks there'll be some good synergy benefit, etc. And we don't always expect, people to have said, right, I've already agreed heads of terms, because I think, you don't know whether you've got the funding to do it perhaps at that point until you've got an investor. But just having that thought process that's not just a M&A on a paper. I think if you've got it in there as building up the business plan, it's got to have some substance behind it. So that's, look, the investment thesis also is obviously, why this business, why now, and what's the value creation, what's the drivers that are going to mean that we come in? Because typically any investor coming in, like myself, is looking to make a return, and they're looking to turn 1 million into 3 million broadly, as a broad brush. And so to be able to do that, it's got to be either in a market that is growing, or if it's not in a growing market, it's a business that has sufficient differentiation in its product or service that means it can take market share through that next 3, 4, 5 year period, which is typically the hold period for any private equity investor. I think there's some other bits around sort of the financial robustness, if you like. These are words like the ESG, your data, the cyber policies. All of that is kind of important, but they're not reasons. You just want to know that they're being taken care of, and you've got policies in place, and you do have the right protections and all those areas. Because now, more and more our investors are keen to see that we're investing in responsible companies that are taking all things like data and regulatory and compliance seriously. I wouldn't worry if you're sat there thinking, crikey, we don't do that yet. Many businesses we get into, at the level of a 2 million EBITDA, do not have all of that at all. They may have thought about it at some level, but they haven't taken it to the next step. And look, that's why when we would come in, we would help. And I sometimes reluctantly say the word professionalize, because I think that's almost indicating that you don't think you're buying a professional business, which isn't the case. What it means is just probably putting a bit more structure and robustness around that compliance piece, because we've been there, we've done it many, many times, and actually we've probably got scars from some of that, which is useful, and we would always bring to bear sort of benefits we've learned from other portfolio companies that we've got, and where they've done it well and where they maybe haven't done it so well. So that's kind of a lot of the finance structure, the business plan. As I say, we do need to have visibility of growth. I'm going to come on now to sort of more of what I would say the probably slightly more interesting but more commercial reasons as to why, when we look at a business plan, we might say that's not quite for us. You kind of take it as a given many times that when you've got you've got an advisor on board, they've probably gone through and given these financials a good kick. So it's all about having that ready almost in a data room, if you've also got, sort of legal, tax and structural housekeeping is probably what I might call it, and having a data room which can simply be a OneDrive, which just has the different folders, even as basic as leases, and anything you've got, just keeping that repository of all the data such that when the time comes, it's easily deliverable to anyone who's taking a look at it. And that could be property stuff, that can be employment, that can be all those different areas, contracts, it can be your supplier agreements. So having that all in one place, that makes a huge difference for when you do push the button, because it will take a lot of you'll be able to do it a lot quicker, basically. So moving on to some of what I would say more commercial elements. So, and in some ways it's more what we don't like as opposed to what we do like. So if you're looking at the commercials of a business, there's certain things that people in private equity don't necessarily resonate with, and that's lower margin businesses are quite challenging. We would always find that's slightly difficult. And what's lower margin? I'm talking gross margin here. So if you're at sort of, you could argue sub 20% is quite low, but certain markets, and I know we had an investment in a facilities management business that did operate at 15% gross margin and was still a great business, and we did very well from that. So it's probably sub 10% gross margin, where that any small tweak on the revenue number is going to impact quite heavily into your overhead base, and you can take the business from some sort of profit to loss with not huge amounts of change in revenue. That's certainly one area that we look at. I think another one is just the customer and the customer concentration. This is probably, I would say, the second or third biggest reason for rejecting or deciding that businesses aren't quite for us, and it will come down to that concentration level. So it's understanding where, if you have it, and that we have equally invested in businesses that have had some concentration. And I think sometimes it's quite harsh to penalise people because they go, look, I've got this customer, it's 40% of my business, I've had them for 10 years, they trust and love us and will continue to do so. And that is fine as a sort of as a statement. I think the bit that we would need to get under the skin of is exactly how contracted and how far does that reach out. And if anyone says to me, well, how big is a concentration that is too big? We've invested in businesses that have got a customer that might be 30% of the business. I think under the right circumstances, that is manageable. Sometimes one rule of thumb can be, well, actually, if you're growing at 25% per annum, well, actually having someone at 25% of your revenue shouldn't be too much of an issue, because you'll soon overtake that, as long as the growth isn't all being driven by that customer. But I think it's fine to have a customer at 20-30%, as long as you haven't got 4 of them that is kind of pretty much your business. So that one of those is going to take a hit to your ongoing maintainable revenue. So that's one that is always a key view when we sort of ask initial questions. What's the concentration, and equally what's the retention and churn? So if you do have that kind of data that is managed and kept live, so how many customers do you typically, new customers do you win during a year, and how many do you churn? That's kind of data is always quite important to us. And what we'd often ask for is, even if you just took the top 10 customers and look at the revenue coming out of those top 10 customers for the last 3 years, you can see trends that's quite telling then actually of how robust the business this is. And look, we understand certain businesses aren't necessarily contracted revenue, and therefore you're going to see customers moving around in that top 10 from year to year. I guess what you want to see is that over a 5-year cycle, these customers do come back to you, whether it's a product business, but they want to keep purchasing over a period, and it's all about that relationship that you've got. So that's important. I think that I touched on the contracted revenue and the visibility of it. We'd always like to understand what's that lead time for when you first meet a customer, when do you convert them, what's that life cycle of that journey, how long does it take? So again, it's all about building up confidence in the forecasts. So if you've got your top 10, 20 customers, it's great to have that just in a summary, which is if they're contracted, when do they expire, how long have they been a customer? What services do you provide? And that will also form any kind of due diligence that will be done. One of the key pieces of due diligence we do is the commercial. Financial due diligence is kind of taken as read. We know there's going to be a financial due diligence. We take a lot of comfort from the fact there's an audited account. And in some cases, I know there aren't audited accounts because we're at the sort of lower levels where it's not necessary. I would encourage you, if you can get audited accounts, if you know there is going to be an exit event coming even in the next 2 years, because what you'll find is, your auditors will always want to go and do a prior year balance sheet, and suddenly it becomes more difficult going back and tracking that. They might have to sort of put some qualification on it. But in most cases, we would ask for an audit to be done. So as part of that process, we might say, look, we do want audited set of accounts, which can delay if we're in exclusivity and going through that process. It's just that robustness, again, we kind of want. But the financial due diligence, I always say this should be confirmatory due diligence. So it's not a process of, right, we need to go and kick everything and find the holes and therefore adjust the price. It's far easier for us as an investment sort of team and thesis, taking our investors with us, is just to make sure that actually everything that's been said is accurate and true, and the financial due diligence confirms that, and therefore that's a much better outcome from the diligence process. But the one bit I did say that we take more seriously is the commercial, and that tends to involve, yes, it will involve an industry expert, it will involve them pulling market stats and data about that particular market segment. But the most important bit for me out of all of it is the conversations with customers. So we would try and get a reasonable coverage of conversations, and we would get an independent commercial DD provider, and you'd work with the business to script however you want it to be. So it could well be it's the business doing market research on their customer relationships, and we would help fuel the questions, and we'd work with the company on, these are the questions we'd like to answer, and all we're trying to get to the back of is, what do people really think of you? What is the NPS score? Will you be continuing to use them over the future? Do you see yourself spending more? Do you see yourself spending less with them? Now, the one sensitive piece around the commercial conversations is, when do you do them? Because whilst it's not a case of picking up the phone and saying, right, this business is being sold, we'd like to know how, whether you like them or not. As I say, it is scripted very carefully to make sure it doesn't raise any concerns with the customers that you might be going through a process. So therefore, it's quite often done right at the sort of at the final timeline of completion. So you've probably already got your financial, and you're comfortable that works. You've done legal due diligence. You've probably done some form of management due diligence as well, or technical or insurance and all those pieces. And you've probably started the commercial due diligence as well. But the actual opening up the customers, where people understandably are quite sensitive to. So that would happen further down the line, once you're pretty comfortable that you're there, you're going to be doing this deal now. What else? I think the sales pipeline. So that's, going back to the commercial, sales pipeline is always something that would be interrogated. Having historic views of that pipeline is pretty helpful as well. So, and look, we don't expect everything to convert, but actually, if you can have a historical tracking of a pipeline that does show, well, actually we convert, 60% of opportunities that get to level 3 or level 4, however you structure that, we tend to convert. And then you can just extrapolate from the data that we're given and say, yeah, actually, look, we can get confidence that the forecasts look achievable. The FDD provider will also give us a view on that as well. But that's definitely, that it comes back to, for us to make a return, there's got to be growth in the business. And yes, we will look to invest in that growth and support that growth, whether it's through people, technology, M&A, or whatever. But there's got to be a hook that the equity story hangs on, which says this is going to grow, because you're not going to, unless you're not going to get an equity investor excited by a flat profile. And at that point, you're probably thinking, well, look, we could refinance something out with debt because it's a robust model that could sustain debt, but it won't bring the returns that we typically look for. So yeah, having all that behind it is probably essential. And I think the final point I will bring on, and I think this is probably the number one reason that we don't invest once we get under the skin of businesses, and it all comes down to the people and the management. I know that perhaps sounds pretty obvious, but what we find is quite often the succession planning is last on the agenda for people. And I get it, if you've got an owner manager who's, it's their business, it's their life, they don't necessarily like the thought of having a new chief exec or a new managing director there sort of running the business. If it's their wealth, it's their biggest asset. But the biggest issue we have is when an owner comes to us with 100% ownership, or even higher, not higher, but in the high levels of ownership, where they say, right, I want to sell my business, and you quite quickly go, right, who's going to run it? And at that point, they kind of say, well, I'll hang around for 6 months. Well, actually, that doesn't really work for us. You need to have thought about this way before. And it could be that you've got, whether it's a commercial director or somebody, but it's someone who has transitioned in over a period where we can turn up and go, right, we will be fully aligned with that individual. That's the person we're backing. And it's not the owner, because they're probably cashing out. That's why it's all about buyouts. That's what we're interested in. We're interested about backing management teams who have got a position, they are running the business, they now want the opportunity to buy off the owners, and that's where we make our alignment and we make our call on those management teams. Now, there are variances to this, because in some cases we will have chief execs who, there might be a chairman who owns 50% and the chief exec owns 25%, say, and there's some other people with the other 25%, and we're cashing out the chairman maybe, and we're asking the management team, who might own 50% collectively, to roll some in with us and take a bit of cash out. That's perfectly fine. But we just need to know that the person and the team that we are backing are within that management team today, and not sort of exiting sort of immediately or even in the near future. So that's probably one that is the hardest for owner managers. But I think as CFOs and FDs, you can help them on that journey. And actually, in some cases, it's not unusual to find the FD is the succession as well. So if you've got someone who's very commercially aware and has kind of backfilled their own business as well, to make sure they've got someone who can come through from wherever it be, financial controller into the FD role, you can see that but these are the people who have got a very clear handle on all the business, not just the finance, it's the commercials, it's happy to manage people, the sales, every part of that business, including operations. But yeah, that's the one that I'd say is most important. And then building down, not just having that one person, but having a second tier of people that we're coming into this business to scale it. So we need to know that there is, and maybe not have the people in there yet, because obviously when we come in, we've got founder managers who might be sat there thinking, well, I'm not going to invest in any, and surprisingly, many don't have an FD as well, because that's, they see that as a cost center. Which is quite amusing. We would always want to put in a CFO or an FD in immediately, for obvious reasons, but sometimes we do have to build out those teams. So, but when I come back to is you do need that individual that you are backing that is aligned with you for the future, and then you can supplement that around the team. But if they've got it in place and they've been thinking about that already, perfect. But it's all about, the alignment is the point I probably laboured on quite a bit there. So look, I think that kind of draws. I think I've probably spoken for too long already, but that kind of draws me to the end of, like, there's a few bits here, and I'm sure we'll try and sort of pull it together into a sensible list of key bits, and hopefully this transcript will be able to decipher my rumblings into something sensible. But I think, there's this piece around the earnings, the robustness, the financials, and then there's kind of the housekeeping bit, then there's the future growth plan, then there's the commercial pieces. And then overarching that, the management and how aligned you will be with them. But that, as a sort of a summary, is key, what we look for. So look, if anyone's got any, if anyone wanted to reach out and have is this private equity, is this a PE ready business? Sometimes the useful, we quite happily have a conversation with people, even if you haven't got that business plan, you haven't got, thought through all of this, because it's still 12 months away or whatever. We're actually happy to have, any conversations that that might be helpful. Stuart.
Thank you so much, David. That's I mean, the reason why you were my first choice to reach out to is because the way that you explain that makes it just free of jargon. It makes it very understandable, and kind of simplifies everything into plain English that even idiots like me can understand. So that's great. We have had a question from David just on the chat here. How do you use non-execs as part of management transition?
Yeah. I mean, yeah, it's interesting actually because I didn't touch on it in the intro, but non-execs for us are hugely important. So quite often when we come into a business, there won't be a non-exec. Sometimes there is, but usually that non-exec is exiting at that point. They've sort of been a sounding board or whatever for the founder, and I mean that not always. Quite often, we when we come in, we do want to find whether it's a chairperson or a non-exec, but that has to be a collaborative appointment between us and the management team, because you can't just enforce somebody that the chemistry has to be right to make that work. And it's typically someone who's been there, done it, got the scars from the sector, has the knowledge, has built a business, taken it from here to here, and has seen the journey that we're about to go on. So to answer the question around, how do we use a non-exec in transition? I think it's. I mean, I don't see that as the solution to the transition, if I'm honest, because I think you need, what we look for is an executive appointment of someone that we're backing. I think that having a good non-exec there is always helpful, and as I say, we'll always put one in, but I don't think it would be the solution to managing a succession. We'd need that to have been done previously. I mean, what we can do is move a chief exec perhaps into a non-exec role going forward if we think there's value in it. But I think that still comes back to the fact that there's somebody else who's been presented to us as the leader of this buyout. And then at that point, we would ask that leader and say, right, do you want the ex-founder to be a non-exec? What value do they still bring to the table? And if there is value, we'd be daft not to retain that if the exiting founder wanted to do that. And we have done that in the past. We've kept people on for 1 year, 2 year, 3 years. They might even roll a bit as well because they still believe in the business. And one thing you have to recognize is that you do have people that have been in the business for many years, have worked an awful lot, and they do have emotional attachment to the company. And in some ways, that's why they come to us, because we're not a trade that's suddenly going to just bash it in and take out synergies. We need to invest in these to grow it, to make a return, which I think is, and if someone's still adding value and wants to be part of it, we'd welcome that.
Excellent. So I've got a question from AJ. It says, what about startups where there is no revenue, but a good business plan with potential customers and an outsourced team?
Yeah, startups is different. I mean, that is that. So look, we're private equity. Startups tend to look for venture capital. Now, I've never done a pre-revenue startup. I have done early stage, which has been loss making. Look, it's a very different beast, that is, because that is. And it probably takes a different type of investor, because you have to, that you are funding losses for a period. And look, I think all the same still applies, though. You're still backing them. You're buying into the management team, and in some ways it's in some ways easier because the money you're putting into a startup is remaining in the business. No one is walking off as a capital gain from this. But the challenge with it is that is where the cash discipline is absolutely key, because what I have learned from only doing a few of the sort of earlier stage startups is that the sort of raw entrepreneurial startup founders, they tend to hit their cost budgets very accurately. They maybe don't hit the revenue budgets quite so accurately. So what you end up needing is, you just need to be able to move quickly to raise further funds. But it's a different type of investor to us.
Yeah, that's great. From Gary, how do you see AI being used during due diligence to make the process more efficient?
Yeah, I think we've got to acknowledge it is going to do that. I think the due diligence process, I mean, if I talk to advisors, they're obviously saying they're embracing AI. I think they probably feel a little under threat because obviously, people are expecting the costs of it to perhaps go down because there shouldn't be so much manual labour involved. But I think, look, there still needs to be the right prompting and the right investment in the tech to be able to do that. So I don't necessarily see the advisors suddenly becoming half the cost because it's all being thrown into AI. I think it will change their model and they need to embrace it, but I think we shouldn't be afraid of it either. And I think the challenge is AI now will look very different even in 12 months. So it's so fluid. My answer today might be completely different in even perhaps 6 months.
Yeah, it's all moving quickly.
Yeah.
David, how different is the process in round 2 of PE financing, i.e. PE refinancing? First PE leaves and a new PE comes in.
Yeah, so we would call that a secondary buyout. And we have done some of those. So that's where we have acquired from an existing, perhaps a smaller private equity firm, and equally we have sold to other private equity firms who are larger than us. I think the one thing I'd say that's slightly different is when you've got an investor on your board and part of that, almost day one on your board agenda is exit. So, and some people are perhaps quite surprised that we're going, right, so what's the plan to exit? So a lot of what I've discussed and described, I would hopefully think is quite well structured and in place if you've already got a financial institute or an investor. Certainly a fund investor, I would say. If it's an angel investor, that's slightly difficult. Not difficult. But I do think, that secondary buyouts, all the same, still applies. But I would expect you've already got the people in the places and the processes in place and the governance I talked about, where actually it should make that process just a lot easier.
Excellent. So this is from Kevin. Great insights, David. Doesn't mention anything about my intro, but I'll let that go. In terms of quality of revenue, do you have view on services revenue versus ARR? What multiples expect to be applied if not fully a SaaS business?
Yeah, so this is always quite interesting because you've got different types of revenue. Clearly, you've got we still invest in businesses that do proper manufacturing and build products. So that's a different type of revenue, and it's harder and you have lower multiples on it because it's less predictable, it's less future proof, and you've got to continually you start your new month, perhaps you've got a blank, you've got to build your order book and sell it. Whereas obviously the SaaS revenues on a subscription basis are much more predictable, and that's why they do attract higher multiples. I think if you were to base it, you'd say product revenues probably less attractive, service revenues attractive, and then SaaS revenues more attractive. But that's purely because you've got this recurring subscription element, and usually it's because it's a pay as you go, and they can't switch it off, and actually you're in more control of that. Even the services revenue can be replaced by somebody else offering the services. Usually the SaaS is just much more stickier. I think when we haven't done a huge amount of sort of SaaS type investments. I think the reason being is that you do get this ARR that is constantly sort of presented, and quite often the multiples are multiples of ARR. Now it depends on how much growth, what's your growth margin coming out of that business, because if it's real SaaS, it should be really high margin because you're just putting more volume through a platform that has no additional cost, and if you can prove that, then your ARR is probably more attractive. And if you've got the growth profile, I'm sure people would pay 4, 5, 6 times ARR, so which is run rate revenue, effectively annual run rate revenue. I think services clearly is different. That's a different element, but services revenue is still attractive. And I go back to the facilities management business we had, that had a lot of contracted revenue. It was all service. There was some projects as well on the side. That was about a third of the business, but 2/3 of it was contracted service revenue, and you can get a lot of comfort from that, and you will pay higher multiples for that.
Excellent. So I think that's all the questions that we've got in the chat. So thanks everybody for that. I think we'll wrap it up there. If there's no more questions, kind of as we're talking, then I think we'll bring that to a close. Naturally, it goes without saying, We can share David's contact details with anybody that's been on the call, and feel free to forward those on to your networks. Reach out if there is anything you wanted to table, or kind of have a chat privately, with regards to this topic, and obviously David's expertise. So I'm going to bring that to a close. Really appreciate your time and your expertise today, David. We will make sure that everybody's contact details are shared that want those. Look out for the transcripts and the recordings that are coming out on LinkedIn. And we will hopefully see you all at the next boardroom on a different topic. And I think one that was mentioned was AI. That's something that we're looking to expand on. So if that is of interest, keep an eye out on our LinkedIn's, and you'll see that. So really appreciate that. We'll wrap up there, and hope you have a great rest of your week. Cheers, everybody.
Yeah, thanks all.